You definitely. Oh, there.
Hi. Well, I don't know if that's the real BV or if he's frozen. Like, we're just gonna get the picture.
We're live, BV. You're frozen with your big gorgeous smile.
Well, it's the Chrisman commentary coming at you semi-live this Friday. We got the last word today.
BV says, "Run with it."
We're going. We got it.
We're going. Lots to talk about. Lots going on this week. Courtney, how are you doing?
I'm great. I'm excited that Brian, even in his frozen status, showed us his support for Michigan State basketball once again today. And Christy was nice enough to dress in support of the Spartans tonight against Ole Miss. So I couldn't be happier.
I did, by the way, pick them in my bracket as an homage to you guys. So.
Oh, we appreciate that. The troubling thing in the state of Michigan this evening is who to root for in the Michigan-Auburn game. This is why. There's a really heartfelt story about the manager of the Auburn basketball team. And if you guys haven't seen that, I'll flip it to you on LinkedIn. But there's a kid who overcame cancer in honor of the coach and wanting to participate in Auburn basketball. And it's a big night for Auburn. So Michigan State fans, we don't have a hard time rooting against Michigan typically, but tonight we have extra moral authority.
Is this the guy who walks out with the boombox with his team?
I don't know the answer to that question, but there's been like all these like Instagram stories that make you cry. Well, maybe not you, Kevin, but make me cry this week watching, kind of feeling like quietly rooting for Auburn after Michigan State.
I mean, I am rooting for Auburn. 29 of my family members have gone there, including including both my parents.
Well, I'm dressed in purple. We're here at the Zactus Customer Advisory Board. That's their color.
Nice.
And,
I have on purple socks.
Yeah, that works. We just dipped out to do the last word, and
big week.
Yeah, never a dull moment in DC. That was actually a pretty hot topic behind closed doors here. We have a gentleman who's this guy Dan, who's part of like the credit. He's basically a credit advisor to everyone who's ever run the CFPB, and talking about maybe why the trigger lead ban bill could be bad. A careful what you wish for moment. If you have to get everyone to opt in, which is not in the language of the bill, but then do we never pull credit unless anyone opts in? And it's very interesting talking about the workings of that. We've got Scott and Taylor from Community Home Lenders of America, CHLA. They're in here as well, together with the leadership from Zactus and some leaders from other lenders. And, we're just talking about all things DC, all things credit. They were just talking about medical debt. I had to tear Christy out of there. She was having a spirited conversation about why she thought medical debt should be taken out. It's a lot of good topics that I think our industry is pretty keyed in on.
Courtney, what is your hot topic this week?
Oh, well, I think that every day we're hearing news, right? And then, if you're working in the mortgage industry, you then see, whatever the feed from the relative investor that is, adjusting to Washington and activities in Washington. I think, or I know that Freddie came out with some clarifying language this morning on some of the things that we saw in the Pulte announcement earlier this week. I think from a servicing perspective instead of a lending perspective, the biggest news of the week is I would call it step back on GSE authority to regulate using, which is really kind of one of the worst, most aggressive, subjective rules that we see. UDAP, either UDAP or UDAAP, depending upon what kind of dirt and what regulation we're talking about. But generally speaking, these were rules promulgated to say, don't do bad stuff, and the regulators have an opportunity to evaluate your underlying processes for bad stuff. Bad stuff is kind of a sliding scale, even though, there are elements to that. I am a consumer-driven human at heart. You don't stay in mortgage servicing. You're paid way less and the work's way harder. unless you do have heart for it. But I think that I do think that it was a green check mark, not a red check mark or red X. With that news this week, for servicing, we don't need another body. We've got the states, regulating us from a consumer protection perspective. We have the CFPB, the OCC, the FRB, I can go OIG, regulating these types of issues, and adding that in the fall seemed a bit of a Hail Mary in the first place. So, good news for the servicing side of the business. I would just say this, because I think that we're still going to be learning what regulating authority or overseeing authority the FHFA is going to, hold over Fannie and Freddie at this point. And it'll be interesting to see how those audits evolve over the course of the next 4 years.
Yeah, we saw it as a green check mark too, not having in our Fannie and Freddie, yearly audits to have to talk about servicer stuff when, like you said, there's all these other entities that regulate it. So just maybe a little bit shorter audit call when we go through that. So
no, they're gonna pick something else.
Yeah,
come on.
They've been pretty cool. For us as an originator at heart, we're built by originators for originators. We definitely took a hit when the non-permanent resident alien step back elimination, if you will, went through. So, and that was, Fannie, Freddie, and Ginnie, right? So, that's a couple thousand loans a year that impact us. I can go to my notes here and try and give you exact numbers of how it impact us, and it's not great, but we did 456 FHA loans and 1,410 non-perm resident aliens overall.
In what time period? A year, a month?
24.
24. Okay.
So what happens is, now everyone's going to have to go, okay, well, we can still do it non-QM, but you require more down payment. And these are borrowers that don't have money. They don't have the down payment. And so that is, that's problematic. And that skews Latino. Latino has been a very big first-time homebuyer segment growing the last few years. Right. And this program is a big part of that, and that, and that growth. And so, you say, coldlessly and heartlessly, like a cap markets person would say, it's a drop in the bucket, the overall, loans that are impacted in the grand scheme of things. But, it still hurts, not having that product and that takeout. So that's definitely a red check mark, in my opinion. And, former FHFA director, Mark Calabria, right, and just to level set with everyone, on here, FHFA directs and regulates Fannie and Freddie. And he is working now at the CFPB and his goal is GSE oversight. So he's helping Bill Pulte. He's helping steer some of the policies. And he's supposed to, as we were told earlier, shift out of CFPB and work over at the, Office of Management of Budget, which means he'll be working directly for Treasury and directing funds to or from a Fannie or Freddie that they're trying to get to go private. And, former director Calabria is a libertarian, and he is all about, LFG, less federal government. And so this administration is in a whirlwind 9 weeks in, making a bunch of changes that are absolutely impacting our business. And so we're trying to keep an eye on it. And in 10 days, Mortgage Bankers Association, TMBA, Broker Action Coalition will be up in DC talking to Congress people about things like the trigger lead bill and FHA reform and stuff like that. But the advice we were given in here was, don't talk to agency heads right now, because they're worried about their footprint, their jobs, what they're going to do. They don't know what their landscape is going to look like. So we're going to ping on Congress in just under 2 weeks and try and push whatever agenda our industry is coalescing around. But the government is shrinking, jobs are shrinking, footprint shrinking. The lawfare, False Claims Acts and prior CFPB actions. Although our industry was pretty much spared in the last go around with the CFPB, that's all shrinking. So, and then, not to take it a step further, but I was watching CNBC headline this morning while I was getting ready, and the Trump administration is targeting the law firms that targeted him the last 6 years. So there's a lot going on. I guess turnabout's fair play, but there's a lot going on in DC right now. So more to come, more head spinning.
I don't want us to forget, like when you start talking about the changes that are happening, these are impacts to individual people and families. And when you remove yourself and you only talk about, well, it's this regulation or that regulation, sometimes the heart and soul comes out of it. And we have to remember that every single thing that happens impacts an individual, impacts a family. And when all of this goes on, then you're creating angst in the marketplace. And the psychology of what's happening can really impact more than just your capital markets guy can go, oh, well, this is a drop in the bucket. But that drop in the bucket has an impact on so many other people and how the market feels. That when consumer sentiment changes, we're going to feel that in more than just the one or two loans that are impacted. And even if you didn't do those types of loans, think about what's going to happen overall in your marketplace when there's fear and there is concern and there is no certainty. So I think that that's something that we have to continuously think about and get out. And I know, here we're educating, the industry and anybody else who chooses to join, but we've got to think about getting out in our communities and educating folks about what's going on, what they should care about, and why home ownership is still a valuable goal and what things aren't changing in the marketplace, and continue to drive that message at the local level.
Yeah, and I'll just say, I don't think it's cap markets people. I think it's the secondary market.
Well, you said that.
Yeah.
So I'm just picking on what you said.
But I didn't say cap markets person. I said the secondary market, which if you guys have listened to me for 24 years, the secondary market is cold, heartless, and unforgiving. Yes. And they buy and sell money, and they're going to find a way to make money. And so, where we stand, as a community lender, it sucks. It's tough. There's some future home owners that just got called out of future home ownership quite a bit. And at the community level,
one of my favorite secondary people, Kevin, last week looked at me directly over a Zoom call and said, "You need to stop having so many feelings about this." And I was like, heard. Thank you for that. So Daniel in the chat has an interesting question, and Kevin or Christy, I think either of you are the experts in terms of shaking this out. He said, to be clear, the non-permanent resident alien ban is currently just for HUD, FHA, unless I missed something, correct? And I think maybe differentiating that between the special purpose credit program changes on the GSE side might be helpful for some of the people that are trying to keep up with everything that happened this week.
Yeah, those special purpose credit programs, which we didn't do one, but there are some lenders that have built some business models around it or include it in their overall strategy. It does include, DACA borrowers or, bars that are non-permanent resident aliens. So
it's both.
So the non-permanent resident alien ban on just NPRA borrowers is a HUD FHA.
Yeah.
The Fannie Freddie special purpose clawback impacts those borrowers as well. So
isn't there a view that this first round, it was boom, 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 boom from Pulte in week 1.5 or whatever it is really just aligning with policy statements that the Executive Office of Government has, indicated so far since January, and we're going to see really kind of the evolution of this, your comments with Mark and others that are advising that office at this point. This is kind of as a baseline, this is how we're going to follow the Trump administration's policies, and then we're going to see further rollout from here.
I would agree with you. I think that there are more changes that are going to come, and if you want to try to predict the future, which is not easy in any environment, and maybe less so in this one, you have to think about what they have said, what this administration has said their policies are, and then go look at every single thing that you do and say, does this align with that or not?
Sure.
And if it doesn't, anticipate there's going to be a change and figure out how you're going to deal with it.
And Director Calabria wanted to privatize Fannie and Freddie, and they wanted to spin them out private. And then the first week on the job for Bill Pulte, they fired the CEO of Freddie Mac and some other, senior people there this is my own independent thought. I have no knowledge whatsoever, but my thought was they're going to get rid of Freddie and just go to one GSE. That was the first thing I thought of when I saw that. They attacked Freddie specifically, and so, which by the way, Mark Hansen sent me an article that a former Freddie employee was live streaming on Facebook, roaming around the DC office of Freddie, saying she was going to blow it up. She got arrested yesterday. So, it's getting a little weird. But if they spin out Fannie into the private sector, I'm not a huge fan of that. I mean, obviously, everyone talks about the explicit guarantee. When we have another global financial crisis, when we have another global pandemic, the private capital could not sustain anything going on. So Fannie, Freddie, and Treasury had to step in. Treasury stepped in and said, all right, we're going to backstop, principal and interest payments for however long. And so one of the interesting things I read about in the last 2 weeks was that if Fannie goes private, that the sovereign wealth fund being created by our government, which I love, actually, man, it's about time we start making money as opposed to just paying debt forever. That sovereign wealth fund could buy some of the preferred shares of Fannie Mae, and in essence, that would be the explicit guarantee. So now the government has, and the government always has had, an interest in, I guess, backstopping housing, but that could be a way to put out an explicit guarantee, one mechanism.
By the way, I agree with the comment Brian just flashed on the screen. It makes the LO's job so much more valuable in today's environment because there's a lot to navigate through. And depending on how in tune you are with what's going on, even us, right? You may miss something that has happened and this changed or that didn't change or this got reverted because it went to a judge and the judge said this. Like the back and forth, and we haven't landed the plane yet on so many of these issues that it is really incumbent upon LOs to stay on top of all of this and really educate their partners, their borrowers, the general public.
That's a big reason why we
point,
do this podcast, right? So everyone who's listening and then who watches later can go back to their teams and educate their teams on how to educate borrowers, because consumers in the soft data are scared. They're scared of tariffs. They're scared of inflation. They're scared of slowing government. Now, I talk a lot about soft data versus hard data. I mean, the hard data, even today, shows that consumers are spending. I mean, they're spending by a wide margin, and so. But
it's a segment of consumers, right? I mean,
the homeowners, right? So, yeah, I mean, if you take just the top 20% of income earners, they're spending 60% of everything in our economy. The homeownership rate is 63%. So people with money are still spending. People without money, who are typically not home buyers, which now it's gotten harder for them to get the down payment, to pay the insurance, to pay ever increasing taxes locally. They're getting left in the dust. And I've always talked about how we look more and more like Europe every day, where there's no real middle class.
Well, but here's what I worry about, and this came out in Elliot Eisenberg's commentary. I think it was this morning, but over the last day or so. And one of the things he talked about is the top 20% of earners not only are spending the money, but they're feeling fairly secure because they have a lot of wealth in the stock market. And if the stock market goes down, then there's going to be a huge psychological impact. And what is that going to do to our economy as a whole? So there are a lot of moving pieces in this that consumers are playing with, and that the government, the current administration is playing with. And where do we end up? And how does that impact just our day-to-day lives?
And that's where I quoted that 60% of spending is done by the top 20%. Was that Elliot Eisenberg, the Bowtie economist, great daily Monday through Friday email. But GDP for Q4 is 2.4%. So anything above 2 is growth. The first Q1 reading from the Atlanta Fed, which initially was -2, is now -0.5 point. And so, what's interesting is the soft data and sentiment and surveys is a 6-month precursor to hard data. So in 6 months, if people are clamping up because they see they're less wealthy in the stock market, or they see that there's actual inflation, which we saw the PCE today rise 0.365, which gets rounded up to 0.4. So it takes it to 2.8. You know, if in 6 months we're still trending in these directions with slowing growth, private wages came down by a significant margin this morning. And I put on my video, 2 days ago, the job switchers are now no longer making more than job stayers. And so if the labor market softens, if inflation's sticky, if the stock market comes down, and we start to see that show up in spending, and that will be slowing growth. And so we have a growth scare right now. We don't have a recession. Maybe we're in one. But if people clam up and, we have slowing growth, the fallout is actually pretty good for our industry, because if we go into a recession, or if the 10-year treasury gets down to 380 or 350, rates are better and we all pick up. And we're all pretty busy right now, I'd say, because 50% of our competition isn't even in the industry anymore. So, that put that's there, that floor that's established, is housing. And housing gets more affordable if we have lower rates. So there is a silver lining if things slow down and people get worried and people clam up and people don't spend. It's that, treasury yields, continue to trend down, not necessarily collapse, but would trend down, and rates get better, and we all, start to thrive, throughout, the second half of the year, after spring purchase season is, peak season ends, we still have better rates. And so there's still an overwhelming wave of demand out there and not enough supply. So these dynamics, they're not all bad.
From a soft data perspective on the servicing side, we are seeing a slow but still uptick in consumer bankruptcy. And that's always a first indication that consumer spending is up, and that people are riding closer to that line of their ability to make their regular monthly mortgage payment. Also, I think that it's important to point out that these are big issues, coming out of Washington, creating noise in areas that actually aren't the problems that we were talking about 60 days ago, like the insurance crisis that the mortgage ecosystem is seeing or not seeing, depending upon how you look at it. The inventory problems that we're doing, all of those things still, the cost of home ownership. Yes, these things do limit access to certain groups of consumers for sure. But I think that, we also have to remember not to take our eye off the ball, particularly, I think, in the context of affordability and ongoing affordability of homes and new purchases. When we see those things, of course, we have to keep up with what's new this week in Washington so that we can understand what products we can offer. But from a servicing perspective, we're still all over insurance. From the heart of the homeowner perspective, we know that it is still a seller's market, and that may or may not go away. Yeah, Bettina Gonzalez in the chat also said that auto default is high. Auto default actually goes first before mortgage default, because if you think about the prioritization of payments, being able to get to work, right? It's exactly. These types of things that they remain issues. They're just not the ones that we're talking about. And you could consider the ones that we're talking about just kind of part of, a shifting presence in Washington. We still need to, do the work on those other problems. I don't know, Christy, if you have thoughts there.
I do. And I also think about what's happening with bankruptcies, because one of the pieces of data that I've been looking at for close to a year now had to do with student loans. And so many people were in forbearance under the CARES Act. And then you had so many people who thought that they were never going to have to pay those loans, that they were going to be forgiven by the last administration. And what the data shows us is that those folks went out and took out additional debt that was the same as or more than what their student loan payments were. And so because of that, now that the student loans are back in repayment, and now that they're being reported, we're seeing delinquencies. And how much is that impacting the bankruptcies that we're seeing and the other delinquencies that we're seeing? And what is that going to do to people's ability to refinance? So let's just assume that we have a bunch of folks that bought houses, and they bought into this, date the rate, marry the home. And they thought they were going to be able to refinance it at some point. But, they forgot about that student loan because they thought it was going to be forgiven and they didn't have to qualify with it. And they went and bought that new car, because we all know new houses and new cars go together. So now their debt is up. Their taxes and insurance have gone up. Their DTI was already pushing it. Now they have delinquent payments. and they have a higher DTI and they don't qualify to refi, we can't put them in a better spot. Where does that make us end up as an industry? Like it's like layer upon layer upon layer. And those are the things that, as you guys are talking about this, that I start to worry about.
And I think that over indexes on, our lower sociodemographic area.
The most vulnerable.
Yeah. And so it just makes it harder for them to become homeowners, and home prices continue to go up, insurance goes up, taxes goes up. The only relief we're going to see are lower rates. And, and so that'll bring some people back into affordability. I read a couple of years ago that when rates went from 8 to 7%, 5 million borrowers came back into the fold to be able to afford a house. And so, we're at 6.8. If we get down into the, low sixes, even high fives, I mean, there's a 4.99% rate out there right now. Like you can get it. So, lower rates is the only affordability cure. And everyone's going to have to deal with, prioritizing debt. But to your point, if someone is also a homeowner and they're defaulting on medical bills, student debt, car loans, private loans, credit card loans, they're not going to qualify to get, even a second lien out. They're going to have to go hard money, which ultimately, is a better rate than 22% on any of the other debt, high credit card debt. I don't know the going rate for student loans, but there's still a spread there where it makes sense, even, going bridge loan or hard money loan or private HELOC equity loan that's above an A paper rate.
That's a lot to think about. We covered a lot in the short, like the 30 minutes goes by so much faster in the last couple of weeks because there is just so much going on to talk about. We appreciate Chrisman hosting this and sponsoring it. And we appreciate everybody who joins us live and who watches in the replays. Any last words, KP, and then to Courtney?
Well, I talk a lot about certainty versus uncertainty, and there's a lot more uncertainty right now coming out of DC. And so that's going to create, a lot of volatility in the stock market. It's going to put pressure on treasury yields to go higher until we get more hard data that says that growth is slowing, labor is softening, most importantly, then we get better rates. We start to win. So these things kind of, they have a flow about them. This flow of money that I talk about all the time. And, I read so much stuff every day, and we're going to keep bringing it to you right here on The Last Word.
All right, Courtney, take us home.
I would just say personal responsibility and conscious choices are, on high. So if you're an LO, or if you're, whoever you are, if you're dealing with a regular person, not a huge property investor, reminding people to really think about their total picture, right? We can advise as much as we can. But at the end of the day, every individual human is responsible for listening to that little voice inside of their head, hopefully, or their heart, maybe multiple voices. Either way, you got to listen to them when you're making large financial decisions, particularly in a market like that. And I think that we probably take that for granted a little bit because we talk about these issues and we're in it all the time. But I think that type of education to consumers always has to be front of mind because at the end of the day, they will be making those regular monthly payments.
That is a fantastic way to end this Chrisman commentary. Thank you all for joining us. Thanks to Chrisman for hosting and giving us the time to do this. We will see you all next week.
Cheers.
Bye.
Go State.